So good morning, traders. Today is Friday, 27th of August, 2021. US dollar Canadian dollar is the pair we're looking at this morning. And this is an education series, actually. And the question is this: how do you know that a correction is just an ordinary correction, that is not going to change to a trend change? So when you have price like this, okay, price breaking higher, and you've seen this printing uptrend series of higher highs and higher lows, and you now witness price coming against the trend. So how can you know whether that correction is going to lead to a trend change, or the correction will stop and continue in the direction of the trend? And I'm going to show you an easy way to find that out. Okay, and this is something that most people overlook. I have I've trained many people that they said to me that Fibonacci and stuff like that, you don't use them. Actually, I'm going to teach you a very simple way to use the Fibonacci to determine whether a correction is just a correction or is going to lead to a trend change. So this is the Fibonacci. We call this one golden. We call this one the, what's it called again, the key ratio. Okay, I have different settings that we have for Fibonacci, but this is the one we use in the key ratio. It's very simple. It's the basic one. Okay, the things that might be different from the standard one is probably the 110 and the minus 23.6. Okay, so this is our Fibonacci. Once you see a correction that has given you 0, A, B, C like this, you have an information in this place. Okay, because 0 to A is the first move, people are still looking to buy. Then the A made a lower IB, so we have these 3 points that we can draw our Fibonacci to. That move from B to C is an information move. We use it to deduce what is going to happen. Remember, we cannot predict the future, we only have to react. The only people that can predict the future in trading are those people, the dynamic traders that can actually move the market. If you know and you you accept that you cannot move the market, then you have to trade with them. Okay, so we have the A to B and A to we have the A to B correction. So the information here for us is the B to C. Where does the B to C end? So this is the trick here. If the B to C ended beyond the minus 61.8, which is what we call the T2, okay? If let's say it comes to the minus 110 or even gets beyond the extension 1, that means the trend will continue. That's the number one that you will know that the trend will continue. If if the move from B to C ended at the minus 23.6, which is what we call the T1, that means the trend will continue and is going to give you extension to the downside. But if the correction of A to B gave you a target of minus 61.8 and price stopped there, that means that correction is just a correction. That is a valid pullback, and you should expect a continuation in the trend after the correction. Okay, so that is the way to find out. And this dollar card, we should be expecting more to the upside because this has printed a complete wave structure to the upside. Okay, so above here is the momentum high. This is a normal correction. Price has given us a pattern for a buy. If we look at this, ABC down, then W up. The center point has been broken. We expect this momentum high to be broken, so I can take out this Fibonacci now. We expect this high to be taken out for continuation. And those that know how to count the wave, this is 0. We're going to see one somewhere above here, then pull back for 2 and continuation, and that continues the wave sequence. 0, 1, 2, 3, 4, and 5, followed by ABC correction. Then that will start all over again for the continuation of the trend. So this is just an education series. The dollar card, we use the correction to find out whether this will be a trend change or a continuation. And that tool that we use is a very simple tool that everybody have on their chart, is a Fibonacci retracement. Okay, the numbers, I'm going to leave you with the numbers for those that are interested in it. Okay, that is the number there. The key numbers you want to see is minus 23.6, minus 61.8, minus 110, minus 161.8, and the minus 200%. Okay, those are the targets area, and you want to use those targets once you see 3 points on your chart. Okay, something like that, and the trend was up before. Let's use the arrow, so you can draw your Fibonacci to know. That will give you the information. If that one matches those levels that I mentioned earlier, minus 23.6, that means don't buy it. If it matches, if it goes beyond minus 61.8, do not buy it. But if this move comes down and stopped at minus 61.8, wait for price to give you something like this, something like a W pattern. Then you can buy it at the failure to take the lower low, and that's your trade. Okay, the opposite is the M pattern. You draw from low to high, wait for correction to give you the target. If it stops as minus 61.8, then you want to wait for the M pattern to form. Then you can sell the second leg of the M pattern to the downside. So that's basically how we use the Fibonacci to determine whether price is in a retracement or is actually going to change the trend. So my name is Shegun, as always. Have a blessed trading day. Okay, and look out for more of my videos.